The automotive landscape is being dramatically reshaped as General Motors delivers a stunning rebuke to America's protectionist trade policies. In what many view as a direct challenge to President Trump's economic vision, General Motors has announced the elimination of 14,000 jobs and the closure of 5 factories across the United States. This bold move exposes the fundamental disconnect between political rhetoric and economic reality. While the White House champions a 200% tariff as the magical solution to revitalize American manufacturing, General Motors has effectively flipped the script, leaving the administration scrambling for answers. The contrast couldn't be more stark. Trump clings to an outdated America First playbook, while General Motors embraces global integration and technological innovation. The disconnect is nothing short of remarkable. As Trump tweets about protecting American jobs through tariffs, General Motors quietly invests over $20 billion in electric vehicle technology, a field that appears entirely absent from the administration's industrial strategy. It's as if the two entities exist in parallel universes, one defined by protectionist barriers and simplistic slogans, the other by global supply chains and technological transformation. When news of General Motors' restructuring broke, many expected a fierce response from the White House. Instead, a telling silence emerged, a tacit acknowledgement that tariffs alone cannot reverse fundamental market forces. While the administration fumbles with punitive trade measures that experts widely criticize as counterproductive, General Motors is methodically positioning itself for the next generation of automotive competition. The numbers tell a compelling story that undermines the administration's narrative. Despite a temporary 3% stock dip following General Motors' announcement, the company quickly rebounded thanks to its international revenue streams. In 2024, General Motors generated over $32 billion from markets outside the United States, a clear indication that global integration, not isolation, drives profitability in today's automotive sector. Perhaps most telling is General Motors' production footprint. Over 40% of its vehicles are now manufactured outside American borders. The company has committed $1 billion specifically to expand manufacturing capabilities in China and India, precisely the markets that tariff policies aim to constrain. Additionally, General Motors has directed $5 billion toward electric vehicle factories in Mexico, effectively sidestepping the very trade barriers designed to keep production domestic. Meanwhile, the 25% tariff on imported vehicles represents a significant gamble with potentially devastating consequences for American consumers. With approximately 7.38 million imported cars sold in the United States annually, these tariffs would dramatically impact vehicle affordability. Analysts project new car prices could surge from today's average of $49,000 to as high as $53,000, placing vehicle ownership increasingly out of reach for middle-class Americans. Market reaction to these misaligned policies has been swift and severe. In a single trading session following tariff announcements, General Motors shares dropped 5%, Ford lost 3%, and Stellantis followed this downward trajectory. These market movements reflect deep investor skepticism about the administration's approach to trade and manufacturing. The administration's mantra of bringing manufacturing back to America sounds compelling in political speeches, but ignores practical realities. Constructing a new automotive plant requires 2.5 to 3.5 years before becoming operational, assuming companies are willing to commit billions despite uncertain policy environments. This timeline doesn't account for restructuring supply chains, retraining engineers, or updating core technologies. When combined with America's higher labor and operating costs, the challenge becomes even more insurmountable. Global competitors aren't standing idle. Hyundai, Toyota, and Nissan have already begun shifting production outside the United States to circumvent these punitive tariffs. More notably, Chinese electric vehicle manufacturer BYD has surpassed Tesla to become the world's top-selling electric vehicle brand. While Tesla maintains its focus on the United States and select European markets, BYD has expanded to over 50 countries across Asia, Latin America, the Middle East, and Africa. The administration's confrontational approach extends beyond the automotive sector. Recent statements dismissing trade relationships with Canada, "We don't need energy from Canada, we don't need lumber from Canada, we don't need anything from Canada," have fractured long-standing alliances. Canada's response was swift and substantial, launching a $43 billion retaliation package that immediately impacted American businesses, with Tesla being the first casualty. The Canadian Ministry of Transport froze $43 million worth of electric vehicle incentives for Tesla, citing concerns about rebate claims. This represents just the opening move in what could become a prolonged trade conflict with one of America's most important partners. Prime Minister Mark Carney's declaration that the old relationship we had with the United States based on deepening integration of our economies and tight security and military cooperation is over signals a fundamental realignment of North American economic relations. As GDP projections from the Atlanta Federal Reserve shift from positive 3.9% to negative 3.8% in just 8 weeks, economic anxiety grows. While the administration touts visions of Boomtown USA, market indicators paint a starkly different picture, one of contracting growth and looming recession. The contrast between rhetoric and reality has never been more apparent. While the administration champions simplistic tariff solutions, General Motors and other manufacturers are quietly reshaping their businesses for a global future. As these policies reshape the automotive landscape, American consumers face higher prices and fewer choices. The dream of car ownership, long a cornerstone of American identity, may become increasingly unattainable for the very citizens these policies claim to protect. What remains unclear is whether these economic tremors represent temporary adjustments or the beginning of profound structural changes in the American economy. As manufacturing continues its global migration and international relationships deteriorate, the automotive industry stands at a crossroads. The decisions made today, both by corporations like General Motors and policymakers in Washington, will reverberate through communities, families, and entire economies for decades to come.